Breaking news. Ford has just slammed the brakes on exports, effective immediately. Buick's international hopes? Crushed. What triggered this sudden shutdown? And what does it mean for you, the consumer? A massive trade war is erupting behind the scenes, and it's not just headlines. It's hitting the roads, the economy, and the global auto game hard. This isn't just about cars. This is about a power struggle between economic giants, and the fallout could impact everything from jobs to prices at your local dealership. Stay tuned, because what's happening right now is bigger than anyone expected. The sudden shutdown. In a move that has sent shockwaves through the global automotive industry, Ford has abruptly halted all vehicle exports to a key international market, effective immediately. This decision, cloaked in urgency and silence, came with no public warning, no phased plan, and no clarity for stakeholders. One day, production lines were humming, shipping containers were being loaded, and supply chains were flowing. The next, a sudden freeze. Ports now sit still with rows of untouched vehicles. Logistics hubs are scrambling to redirect inventory, and employees across continents are left asking, what just happened? Behind the scenes, the decision appears to be the product of escalating tensions that have been quietly building for months. Trade negotiations have been faltering. Regulatory red tape has thickened. Political pressures, economic instability, and whispers of tit-for-tat sanctions have all coalesced into a perfect storm. Ford's export arm, once a reliable engine of global revenue, has now been brought to a screeching halt. It's not just about lost sales. It's about strategic positioning in a rapidly shifting geopolitical landscape. This isn't merely a supply chain hiccup. It's a full-scale disruption. Dealerships overseas are already reporting mass cancellations of pre-orders, especially in high-demand segments like trucks and EVs. Executives are being pulled into emergency boardroom meetings. Even suppliers, many of whom rely heavily on Ford's export volume, are facing immediate production slowdowns. Billions of dollars are now at risk, and the message is clear. Ford isn't just making a business decision. This is a warning shot, and the silence from Ford is deafening. No press conference, no detailed statement, just a terse internal memo leaked within hours, confirming what insiders feared. This was not a temporary pause. It's indefinite. The language was sharp. Due to evolving external circumstances, all outbound shipments are suspended until further notice. But what are those circumstances? Trade war fallout? Retaliatory tariffs? Political intervention? Whatever the true catalyst, the implications are staggering. With Ford's export lines down, pressure is now mounting on other American automakers to either fall in line or face similar consequences. The question now isn't just why Ford shut down exports. It's what's coming next. The fallout for Buick. If Ford's sudden export shutdown was the opening shot, then Buick may be the first casualty. In the immediate aftermath of Ford's decision, General Motors' Buick division is facing a staggering operational and strategic collapse, one that could reshape its role on the global stage, possibly for good. Once heralded as GM's crown jewel in the Chinese and international markets, Buick has now been caught in a geopolitical vice, squeezed by trade tensions, regulatory retaliation, and market instability that has left its future in deep uncertainty. For years, Buick thrived abroad. In fact, its very survival was tied less to the U.S. consumer and more to its dominance in China, where it became a symbol of prestige and comfort. But now, with Ford's shutdown triggering alarms across the auto industry, Buick supply chains have begun to falter. Key shipments of parts, finished vehicles, and raw materials are either delayed or outright canceled. Production timelines are unraveling. Factory floors in North America and Asia are slowing down, and inventories at overseas dealerships are plummeting. Executives within GM have reportedly held emergency calls with trade advisors and government liaisons as they scramble to predict and survive the fallout. The collapse is more than financial, it's reputational. Buick's brand, long built on consistency and reliability abroad, is now shadowed by unpredictability. Customers in foreign markets who once saw Buick as a symbol of modern American luxury are witnessing sudden delays, lack of model availability, and customer service breakdowns. Pre-orders are being scrapped. Social media in China, one of Buick's largest markets, is ablaze with confusion, complaints, and conspiracy theories. GM has attempted damage control, issuing soft reassurances that global operations remain stable. But insiders know the truth is far more volatile. Worse still, Buick was depending on upcoming EV launches to cement its relevance in a rapidly electrifying global market. Those plans now face indefinite delays. Battery modules sourced internationally, software updates reliant on secure cross-border data flows, and global marketing rollouts have all been disrupted. Engineers are being pulled off innovation projects to assess risk and mitigate shortfalls. The message inside Buick's walls is clear: pivot now or perish. And yet, GM may have limited room to maneuver. If it attempts to defy the shifting political winds and maintain export pipelines while Ford pulls back, it could face retaliatory tariffs or regulatory crackdowns that would damage its bottom line even further. If it follows Ford's lead and shutters exports of its own, it surrenders one of its strongest international brands at a moment when global competition is only intensifying. The ripple effect is massive. Buick's collapse doesn't just hurt GM. It sends a clear signal to other automakers, investors, and international partners. The U.S. auto industry is no longer insulated from geopolitics. The trade war has crossed into the showroom, and Buick, once a global ambassador for American automotive excellence, may now become the cautionary tale. The hidden trigger. Beneath the surface of Ford's dramatic export halt and Buick's unraveling global presence lies a shadowy catalyst, a hidden trigger that has only recently begun to emerge. On the surface, the official story points to evolving external conditions and market volatility, but sources close to trade negotiations, industry regulators, and political insiders paint a far more ominous picture. The real reason this crisis erupted wasn't a single event. It was a slow-burning fuse lit months, even years ago. And now, it has ignited into a full-blown geopolitical firestorm. At the heart of the disruption is a sharp escalation in trade hostilities between the United States and China, a complex chess match of economic pressure and political brinkmanship. According to multiple insiders, a confidential series of retaliatory measures were drafted by Beijing in response to new U.S. sanctions on Chinese-made semiconductors, rare earth materials, and EV batteries. What few outside the upper echelons of government knew was that these materials are essential to the production and operation of virtually every modern vehicle Ford and GM manufacture, especially their EV fleets. Then came the quiet bombshell. China allegedly threatened to impose a sweeping export restriction on key components used in American-made vehicles, particularly battery-grade lithium, magnesium alloys, and advanced automotive chips. These weren't ordinary tariffs. These were potential blacklists, quietly delivered through back-channel diplomacy and leaked to just a handful of industry players. Ford, sensing the danger and the scale of exposure, made a preemptive move to suspend exports entirely rather than risk being caught mid-shipment with goods that might be confiscated, taxed into oblivion, or stranded by customs. Meanwhile, U.S. policymakers were tightening the screws on their end. Recent legislation designed to curb reliance on foreign manufacturing, most notably the Foreign EV Compliance Act, quietly introduced clauses that would penalize automakers sourcing components from nations deemed strategically adversarial. For multinational corporations like Ford and GM, this introduced a legal and financial minefield. Exporting vehicles with even a trace amount of Chinese-sourced tech could now trigger audits, penalties, or bans from lucrative federal EV incentives. The automotive giants were trapped. Ford pulled the emergency brake. Buick, overcommit to a Chinese supply and demand cycle, was left exposed. There is also the rumor, still unconfirmed, but whispered in boardrooms and policy circles, that U.S. intelligence agencies intercepted internal communications suggesting that foreign governments were preparing to disrupt American supply chains as part of a broader trade counteroffensive. Whether this intelligence was verified or simply used to justify corporate panic remains unclear. But what is clear is that automakers began scrambling for cover before the first official blow was struck. This wasn't about market conditions. This was about survival in a brewing economic war, where vehicles are no longer just consumer goods. They are strategic assets. And now that this trigger has been pulled, the rules of engagement for global trade have changed, possibly forever. Economic shockwaves. The reverberations from Ford's shutdown and Buick's unraveling are now surging across the global economy like a rolling earthquake, subtle at first, but growing in strength, depth, and consequence with every passing day. What began as a corporate maneuver is now manifesting as a structural disruption, one that could redefine how countries build, buy, and trade not just cars, but the very systems that support modern industry. The automotive sector is often seen as a bellwether for economic health. It's a nexus of manufacturing, labor, technology, logistics, and consumer sentiment. So when a titan like Ford slams the brakes on exports, it's not just its own balance sheet that takes a hit. It's the entire industrial ecosystem. Suppliers of everything from microchips to brake pads are seeing sudden order cancellations. Warehouses filled with precision parts are stuck in limbo. Freight companies are rerouting or losing contracts. The shock is multiplying down the chain, hitting small and medium-sized enterprises who can't afford the delay. Stock markets reacted swiftly. Ford and GM shares dipped immediately following the news, but the tremors extended far beyond Detroit. Semiconductor stocks tumbled amid fears of decreased automotive demand. Shipping and logistics firms that rely on trans-Pacific trade lanes began issuing profit warnings. Commodity traders flagged volatility in aluminum, copper, and lithium markets, all essential to auto manufacturing. One analyst put it bluntly, "This isn't just a car story. This is a global supply chain story, and it's breaking wide open." Jobs are now on the line. Plants in Mexico, the U.S., and parts of Southeast Asia that manufacture for export are slowing production, with shifts being cut and temporary layoffs already underway. In overseas markets, particularly in China and the Middle East, dealerships are being starved of inventory. Salespeople are losing commissions, showrooms are closing early, and long-term business relationships are fraying. What was once a seamless global engine of growth is now sputtering with uncertainty. And it doesn't stop with autos. The automotive industry consumes massive amounts of raw materials, advanced tech, and industrial energy. A slowdown here translates into cascading demand destruction elsewhere. Energy markets may see lower refinery demand for gasoline and diesel. Mining operations, especially those extracting rare earths and battery minerals, could suffer from falling prices and contract renegotiations. Even the global insurance and finance industries, heavily invested in shipping and automotive lending, are reassessing risk exposure and rebalancing portfolios. On the consumer side, the shock will be delayed but devastating. With exports frozen and future production uncertain, vehicle availability, especially for popular EVs, hybrids, and SUVs, will tighten dramatically. Prices are expected to spike as domestic inventories dwindle. Leasing terms could worsen. Financing costs could rise in response to increased manufacturer risk. And for consumers who have already placed international orders or expected overseas delivery, chaos is unfolding. Delayed timelines, incomplete documentation, and abrupt cancellations. Government leaders are not blind to this. Emergency meetings between trade departments, economic advisors, and central banks are already underway. The White House has reportedly briefed the Treasury and Commerce departments on worst-case scenarios. Meanwhile, foreign governments are demanding clarity and even issuing veiled threats of retaliation. This is no longer just a corporate adjustment. This is an economic aftershock that's testing the resilience of global capitalism itself. If a single export halt can trigger this level of instability, what happens when the next company follows suit? Or worse, when entire sectors shut down? We may be witnessing the beginning of a deep fracture in the interconnected global economy. And the repair bill could be astronomical. China's role revealed. As the crisis deepens and global markets reel from the shock, one thing is becoming unmistakably clear. China is not just a player in this unfolding drama. It may be the architect of its most devastating act. For years, China and the United States have danced on the edge of economic confrontation. But now, with Ford's shutdown and Buick's collapse as high-profile casualties, the mask is off. This is no longer a battle over tariffs. This is a strategic power play, and China is moving with precision. The roots of China's response run deep. For decades, China welcomed U.S. automakers with open arms, offering access to its massive consumer base in exchange for manufacturing investment and tech sharing. Buick, in particular, became a symbol of this cooperation, with its sleek sedans dominating Chinese roads and local factories churning out vehicles tailored to Chinese tastes. But underneath that partnership was a calculated strategy: leverage access to the world's largest auto market to become a global electric vehicle powerhouse, faster, cheaper, and more self-reliant than the West. Now, the tables have turned. With China leading the world in EV battery production, rare earth refinement, and manufacturing scale, the country holds immense leverage over the very components the U.S. auto industry needs to survive the next decade. And when Washington escalated sanctions on Chinese tech firms, restricted access to advanced semiconductors, and poured funding into reshoring initiatives, China began tightening the screws in return. According to confidential diplomatic sources and leaked industry reports, China has quietly enacted what analysts are calling targeted friction policies, unofficial but powerful tools designed to disrupt U.S. companies operating on Chinese soil. Delays in customs approvals, sudden safety audits, ambiguous regulatory changes, and covert pressure on local suppliers to cut ties with U.S. firms have created a hostile and uncertain environment for automakers like Ford and GM. These policies are difficult to document, but their effects are undeniable. Production halts, component shortages, and soaring costs. The tipping point may have come with an internal directive, circulated among Chinese trade authorities and now surfacing in global media, that outlined plans to reduce reliance on U.S. auto partnerships by 2026. That document, though not officially confirmed, laid out steps to boost domestic EV brands like BYD, XPeng, and NIO, while phasing out joint ventures with American automakers. For Buick, whose success in China relies on its joint venture with SAIC, the signal was unmistakable: you're no longer essential. At the same time, China is flexing its dominance in rare earth materials, specifically neodymium, lithium, and cobalt, by threatening to restrict exports through licensing quotas and environmental compliance laws. These minerals are the lifeblood of modern EVs. Without them, Ford's F-150 Lightning and GM's Ultium platform are dead on arrival. Industry analysts estimate that even a moderate cutback could paralyze American EV production for 6 to 12 months, sending shockwaves through tech, transportation, and energy sectors alike. And it doesn't stop at materials. China is aggressively promoting its own EVs abroad, seizing market share in Europe, Latin America, and the Middle East, regions once dominated by American brands. By crippling its Western competitors from within while expanding its global reach, China is executing a two-pronged strategy: economic attrition at home and market conquest abroad. For now, Beijing remains outwardly calm, publicly denying any malicious intent while quietly advancing its goals. But behind the diplomatic smiles lies a coordinated campaign to shift the global balance of power in its favor, starting with the automotive industry. What's happening to Ford and Buick is not collateral damage. It's the consequence of underestimating how far China is willing to go to win the trade war and reshape the future of mobility on its own terms. Jobs on the line. As the trade war spills from boardrooms into real-world consequences, the next and perhaps most devastating blow is now landing directly on workers, tens of thousands of them. From Michigan to Mexico, from Shanghai to Sao Paulo, jobs that once felt secure under the industrial might of giants like Ford and GM are now dangling by a thread. What began as a geopolitical standoff is now manifesting in canceled shifts, frozen hiring, and a creeping sense of dread across factory floors and office cubicles alike. The first cracks are already showing. In the U.S., multiple Ford plants geared toward export production, especially those tied to high-demand EVs and SUVs, have abruptly reduced operations. Third shifts are being cut. Overtime is vanishing. Some temporary workers have already received layoff notices. Full-time employees, many of whom are protected by union contracts, are being reassigned to lower-volume models or placed on indefinite standby. Morale is plummeting. Union representatives report confusion and rising anger, with internal meetings turning tense as workers demand answers that corporate leadership has yet to fully provide. But the pain doesn't stop there. GM, already reeling from Buick's unraveling in China, is being forced to reassess staffing needs across its global export supply chain. In Mexico, where key manufacturing hubs like Silao and Ramos Arizpe help build U.S.-branded vehicles for international markets, contract workers have been told to expect temporary suspensions. In South Korea and Brazil, where Buick and Chevrolet models are assembled for Asia and Latin America, executives are reviewing workforce reductions in anticipation of sustained market contractions. Part suppliers, too, are hemorrhaging jobs. These smaller, often family-run businesses provide everything from wiring harnesses to aluminum castings, and many depend on stable, long-term contract from Ford and GM. With orders suddenly canceled or reduced, layoffs are hitting hard and fast. In Ohio and Indiana alone, several Tier 2 suppliers have issued WARN Act notices, warning of potential mass layoffs within 60 days. In total, analysts estimate that over 75,000 direct and indirect jobs are now at immediate risk if the export freeze and trade retaliation continue into the next quarter. And it's not just factory workers. Engineers, logistics coordinators, marketing professionals, and dealership staff are all feeling the impact. EV development teams are being told to pause projects tied to global launches. Overseas sales staff, particularly in China, where Buick once thrived, are facing mass terminations as inventories dry up. Back-office workers supporting export documentation, compliance, and foreign service logistics are being reassigned or let go altogether. What makes this especially dangerous is the uncertainty. Unlike traditional economic downturns, where layoffs follow clear patterns of consumer slowdown or cyclical demand dips, this crisis is politically driven and unpredictable. HR departments are unable to provide timelines for return-to-work plans. Managers can't say whether overseas markets will reopen next month or next year. And for workers, that uncertainty is the hardest part. Communities are bracing for the fallout. Local economies in manufacturing towns, already fragile from years of automation and outsourcing, could be devastated by another wave of layoffs. Mortgage payments, healthcare coverage, retirement plans, all are on the line. This isn't just a trade war anymore. It's a labor war, and the casualties are stacking up. If policymakers and corporate leaders fail to find a path forward soon, the consequences will be more than economic. They'll be human. For the families who've spent generations building America's auto legacy, the question now isn't what happens to the brand. It's what happens to us. Retaliation incoming. The trade war fire has been lit, and the next explosion is already on the horizon. With Ford's export freeze rippling through the global economy and Buick's market collapse drawing international scrutiny, retaliation from America's rivals is not just expected, it's imminent. In diplomatic corridors and economic war rooms, plans are being drafted, sanctions are being sharpened, and a new phase of tit-for-tat escalation is ready to begin. This time, the gloves are coming off. At the center of the coming retaliation is China, whose response is expected to be swift, calculated, and devastatingly precise. Beijing has already hinted, albeit subtly, at an upcoming wave of countermeasures designed to strike at the heart of U.S. economic interests. High-ranking officials from the Ministry of Commerce have stopped just short of confirming reports that China will begin tightening export controls on critical minerals, including lithium, graphite, rare earths, and cobalt, which are essential for electric vehicle batteries, smartphones, defense technologies, and aerospace systems. If implemented, these restrictions could choke U.S. production lines within weeks. But it won't stop with materials. Industry insiders and foreign policy experts warn that China may also begin weaponizing regulatory compliance, imposing new, unpredictable safety and emissions standards specifically designed to exclude American vehicles from Chinese roads. This could be a silent but lethal blow to brands like Cadillac, Lincoln, and Buick, which rely on China's vast consumer base for a significant portion of their sales. Local authorities may also begin revoking dealership licenses, stalling import approvals, or issuing surprise inspections that delay deliveries indefinitely. And it's not just China. Other nations caught in the geopolitical crossfire are preparing responses of their own. The European Union, which has been quietly seething over U.S. subsidies under the Inflation Reduction Act, may seize this moment to challenge American automakers on trade grounds, possibly launching anti-competitive investigations or slapping tariffs on U.S.-made EVs. Countries in the global south, who feel overlooked in U.S.-China power plays, are now being courted by Beijing with promises of cheaper vehicles, infrastructure deals, and technology partnerships, further isolating U.S. manufacturers. Meanwhile, American corporations that do business overseas could be next in the crosshairs. Tech giants, defense contractors, and financial institutions are watching the auto industry with alarm, knowing that if retaliation spreads, they too may face targeted regulatory pressures or access limitations in key foreign markets. In response, internal task forces have been activated across Fortune 500 companies to model worst-case scenarios and prepare for economic warfare. On Capitol Hill, lawmakers are bracing for impact. Already, influential voices in Congress are calling for retaliatory tariffs of their own, along with new legislation aimed at tightening foreign investment rules and sanctioning state-backed companies tied to retaliation efforts. Some are even pushing for emergency stimulus funds to protect American workers caught in the crossfire, suggesting that Washington believes the worst is yet to come. The global economic order is now teetering on a knife's edge. What was once a battle over trade balances has transformed into a multi-front war of influence, resources, and dominance. Every retaliatory action fuels another. Every strategic blow invites a counterstrike. And with automakers caught in the middle, the industries of tomorrow, EVs, semiconductors, green energy, are suddenly battlefield terrain. Retaliation is no longer theoretical. It's incoming. And the world's largest economies are speeding toward collision. Brakes off, headlights flashing, with no one willing to swerve. As the dust begins to settle from the initial shockwaves of Ford's drastic export freeze and Buick's downfall, one thing is clear. This is only the beginning. The trade war has gone from a political game to an economic battlefield, with millions of jobs, billions of dollars, and the future of the global automotive industry hanging in the balance. With retaliatory measures already on the horizon and no resolution in sight, the stakes have never been higher. But amidst the chaos, the real question remains: who will emerge victorious, and who will be left behind? Will the American auto giants rebuild and adapt, or will they be consumed by the very global forces they help shape? Only time will tell, but one thing is certain. This is a pivotal moment in history, and its impact will be felt for years to come. Thanks for joining us on this deep dive into the escalating crisis. Be sure to like, subscribe, and hit that notification bell so you don't miss the latest updates as this story continues to unfold.